Most people learn that the Great Depression began on Wall Street. On October 29, 1929, sell orders flooded the New York Stock Exchange. Prices collapsed. Fortunes vanished, and the confidence of an age seemed to disappear beneath a storm of ticker tape. That moment mattered. In only 10 weeks, stocks listed on the exchange lost roughly half their value. But the American economy had already reached its business cycle peak in August, before the most famous days of the crash. And even after Wall Street fell, most banks were still open. Most deposits still existed, and most workers still had jobs. The crash was a devastating shock. It was not yet the catastrophe remembered as the Great Depression. To understand how that catastrophe became possible, the story has to begin not with a stock certificate, but with a war debt. The First World War was fought with artillery steel coal ships and millions of soldiers, but it was sustained by ledgers. Governments borrowed on a scale that transformed the balance of financial power. European states sold bonds, raised taxes, drew on gold reserves, and purchased enormous quantities of food fuel and weapons from abroad. Gold moved toward the United States as European buyers paid for American exports. American banks and the federal government extended credit to the Allied powers. By the end of the conflict, the old financial map had been reversed. Before the war, Europe had supplied much of the world's investment capital. After it, Britain and France owed the United States billions of dollars, Germany faced reparations claims, and New York had become indispensable to the reconstruction of an exhausted continent. The peace settlement did not erase those obligations. It organized them into a political system. Germany was expected to transfer reparations to the victorious European powers. Britain and France, carrying their own wartime debts, were expected to make payments to the United States. Each government could defend its position with a logic that made sense at home. American officials argued that debts were contracts, not gifts. French leaders pointed to devastated towns, destroyed factories, and the cost of rebuilding invaded territory. British officials faced debts larger than the reparations they could realistically collect. German governments confronted taxpayers who believed the demands were economically impossible and politically humiliating. No single ledger contained the entire crisis. The danger came from the way the ledgers were connected. The Dawes Plan of 1924 appeared to solve the problem. It reduced Germany's immediate annual burden, reorganized payment schedules, supported currency stabilization, and opened the way for a large international loan. American capital then flowed into German banks, municipalities, utilities, and industries. Germany used part of the foreign currency it obtained to meet external obligations. Britain and France used part of their receipts to service debts owed across the Atlantic. Money moved in a circle from American investors to Germany, from Germany to the former Allied powers, and from those governments back toward the United States. The circle produced real recovery. German factories reopened. European currencies stabilized. American bond buyers received interest. Yet the arrangement contained a quiet weakness. It required private lending from New York to continue. A political settlement had been built on the willingness of investors to keep purchasing foreign debt. Gold gave the arrangement an appearance of permanence. Before 1914, the international gold standard had become associated with stable exchange rates and predictable payments. After the war, political leaders tried to reconstruct that world, but the rebuilt system carried the name of the old order without fully recovering its flexibility. Governments returned to gold at different moments with different reserves, different debts, and different domestic pressures. Britain restored the pound to its pre-war gold value in 1925, a decision intended to recover the prestige of sterling and London finance. Yet, a strong pound made British exports more expensive and placed pressure on wages, prices, and employment. France stabilized its currency at a more competitive rate and accumulated gold. The United States also held immense reserves. Gold existed, but it was distributed unevenly, and countries losing it were expected to contract credit until confidence returned. This was the bargain hidden inside monetary stability. A fixed exchange rate was not simply a number printed in a financial newspaper. It was a commitment that could determine interest rates, bank lending, government budgets, wages, and employment. When gold flowed out, a central bank could raise rates, restrict credit, and make domestic money scarcer. Those measures might protect the currency, but they could also close factories and increase unemployment. In theory, countries receiving gold would expand, helping restore balance. In practice, creditor nations could keep reserves idle, while debtor nations were forced to adjust through deflation. The system demanded that governments place international credibility above domestic relief. That demand would become lethal after 1929, but the constraint was already visible during the decade of prosperity. At the center of this fragile cooperation stood individuals rather than a strong international authority. Benjamin Strong, governor of the Federal Reserve Bank of New York, worked closely with central bankers such as Montague Norman at the Bank of England. Strong understood that American credit conditions affected more than the United States. He helped develop the use of open market operations, purchases and sales of government securities that could influence interest rates and the availability of credit. This was an important institutional innovation, but it was not a world government for money. The Federal Reserve itself was divided among regional banks and a board in Washington. European central banks answered to different political pressures. Cooperation depended on judgment, personal relationships, and a shared belief that the gold system could be preserved. Strong's death in 1928 did not single-handedly cause what followed, but it removed an influential advocate of coordinated action at a dangerous moment. Inside the United States, the decade looked more secure than it was. Automobile factories, electrical utilities, radio manufacturers, construction companies, and advertising agencies created the image of a modern consumer economy. Families bought cars and appliances on installment plans. Corporations issued securities to finance expansion. Cities rose vertically, suburbs spread outward, and the stock market seemed to convert industrial growth into personal wealth. But prosperity was uneven. Durable goods could be postponed when confidence weakened. Construction depended on financing. Installment purchases drew future income into the present. And outside the brightest cities, American agriculture had been suffering for years. Wartime demand had encouraged farmers to borrow purchase machinery and cultivate more land. When European production recovered and crop prices fell, many farmers were left with debts contracted under far better conditions. That contrast mattered because the United States did not possess one seamless banking system. It contained thousands of institutions, many of them small local, and tied to the economic fortunes of a particular town or farming region. A city bank with diversified customers could survive losses that overwhelmed a rural bank dependent on crop prices and land values. When a farmer could not repay a loan, the loss did not remain on one farm. It weakened the bank that held the note. A weaker bank became less able to finance merchants' equipment purchases and the next planting season. Long before crowds formed outside banks in the early 1930s, local credit systems had begun absorbing the damage created by falling agricultural income. The celebrated boom and the neglected farm depression were not separate American stories. They were connected through debt. Then came speculation. Rising share prices attracted wealthy investors, middle-class professionals, corporations, and lenders willing to provide money for purchases of stock. Margin accounts allowed buyers to control securities with only part of the price paid in cash, increasing both potential gains and potential losses. Loans to brokers expanded as money flowed toward Wall Street. Yet speculation alone does not explain the depression. A stock bubble can collapse without destroying an entire economy. The deeper danger was that officials tried to restrain the market through policies that affected credit far beyond the exchange floor. During 1928 and 1929, the Federal Reserve tightened monetary conditions as it attempted to check speculative lending. Because the dollar stood inside an international gold system, tighter American credit also placed pressure on countries that depended on capital from the United States. The result was a contradiction. Europe needed continued American lending to maintain the post-war payment structure, while American authorities increasingly wanted to pull credit away from speculation. Germany needed foreign funds to support investment and external payments, but investors could earn extraordinary returns at home. Britain needed room to defend sterling without crushing domestic industry, yet higher American rates drew gold and capital toward New York. Each decision could be justified within its own institution. The Federal Reserve was not trying to destroy Europe. Investors were not required to finance foreign governments forever. British officials were not irrational to defend a currency that supported London's global role. But when these individually defensible choices interacted, The system began to drain the very credit on which its stability depended. This is why historians have argued over where the Great Depression truly began. A purely domestic account emphasizes speculation, weak consumption, agricultural distress, slowing construction, and a decline in investment. An international account developed by scholars such as Peter Temin and Barry Eichengreen places greater weight on the damaged post-war order and the constraints of gold. Charles Kindleberger added another problem. Britain no longer had the power to stabilize the global economy as it once had, while the United States possessed enormous financial influence without fully accepting the responsibilities of international leadership. These interpretations do not cancel one another. They describe different levels of the same machine. Domestic weakness made the United States vulnerable. International debt transmitted pressure. Gold restricted the response. Institutional fragmentation made coordinated rescue uncertain. By the summer of 1929, the weakness was no longer theoretical. The National Bureau of Economic Research later dated the American economic peak to August. Industrial momentum had slowed. Automobile production and construction were vulnerable. Foreign lending had weakened. Farmers were still carrying the burden of a depression that urban America had largely ignored. Yet the stock market continued to offer a bright, moving image of prosperity. When prices began to break in October, the violence of the selling exposed how much confidence had been built on expectations of permanent growth. On Black Thursday, bankers attempted to steady the market. On Black Tuesday, the decline accelerated. Newspapers filled with numbers large enough to seem like the disaster itself. But the most important institutions had not yet failed. Depositors could still enter banks and withdraw cash. Businesses could still seek working capital. The money supply had not yet suffered its most destructive contraction. The international gold standard still stood. The post-war debt circuit still existed, damaged but not completely severed. October 1929 destroyed an illusion, erased wealth, and deepened a recession already underway. What it did not do was make mass unemployment, thousands of bank collapses, and years of deflation inevitable. That transformation would require another sequence of choices. The market had delivered the shock. The banking system, the Federal Reserve, and the gold standard would determine how far it traveled. The next stage of the Depression did not begin with another spectacular day on Wall Street. It began in quieter places, an automobile showroom with no customers, a furniture store holding unsold inventory, and a factory manager removing names from the next week's work schedule. Families frightened by the crash-postponed purchases that could wait. Businesses responded to weaker sales by reducing production-canceling equipment orders and dismissing workers. The dismissed workers then spent less, weakening another group of businesses. The stock market decline had become a demand crisis. But even this downward movement did not yet explain why the economy would lose almost one-third of its output, or why unemployment would eventually reach roughly 1 worker in 4. For that to happen, the decline had to pass through the institutions that created and circulated money. A bank could appear solid from the street while becoming dangerously fragile inside. Depositors expected to withdraw their money whenever they wished, but banks did not keep every deposited dollar in a vault. They used much of it to make loans or purchase assets. Under ordinary conditions, this arrangement supported investment, commerce, and growth. Under panic conditions, it created a race. A bank might own farms, mortgages, business loans, and securities worth more than it owed, yet still lack enough cash to satisfy hundreds of depositors arriving at once. Selling assets quickly meant accepting fire sale prices. Calling in loans meant forcing already struggling borrowers to repay immediately. Each depositor could make a rational decision by withdrawing early. When thousands made the same decision, rational self-protection became collective destruction. The American banking structure made that destruction easier to spread. More than 8,000 commercial banks belonged to the Federal Reserve System when the first major panics arrived, but nearly 16,000 did not. Many small institutions held reserves through correspondent banks in larger cities. A rural bank needing cash might have to request it from a city bank facing similar demands from dozens of other institutions. Some reserves existed partly as checks still moving through the collection system, rather than as physical cash ready for withdrawal. The Federal Reserve had been created after earlier panics, but access to its support remained uneven. The country possessed a central bank, yet much of the banking system still operated beyond its direct protective reach. The architecture appeared national on paper and remained fragmented in practice. The first decisive rupture came in November 1930. Caldwell and Company, a rapidly expanding southern financial conglomerate involved in banking, insurance, and brokerage, collapsed after losses, and internal transfers weakened institutions under its control. When major Caldwell affiliates closed, the shock moved through networks of correspondent banks. Local institutions lost access to funds. Depositors in neighboring towns saw one bank close and began questioning the safety of the next. Within weeks, hundreds of banks suspended operations. Some would eventually reopen, but many would be liquidated. The significance was larger than the number of closed doors. The panic demonstrated that the financial system could transmit fear across regions without any new stock market crash. A failure in Nashville could damage a bank in a distant community because the banks were connected by reserves, loans, checks, and confidence. The panic began to ease, and then New York delivered another shock. On December 11, 1930, the Bank of United States, the fourth largest bank in the city, ceased operations after an attempted merger failed and depositors rushed to remove their money. Its name suggested an official institution, although it was a private commercial bank, and its large immigrant depositor base made the human impact especially visible. The failure filled newspapers across the country. A family reading those reports did not need to understand the bank's balance sheet. The lesson seemed simpler. Even a large bank in the financial capital of the United States could disappear. The public began converting deposits into currency, while surviving banks became more cautious about lending. Fear did not merely move money from one account to another. It moved money out of the banking mechanism that multiplied credit throughout the economy. This was the moment when alternatives still existed. A central bank confronting panic could lend freely against sound assets, supply reserves to threatened institutions, purchase securities, and convince the public that cash would be available. But the Federal Reserve was not one mind. Regional banks disagreed about how far their responsibility extended. The Federal Reserve Bank of Atlanta acted aggressively to support member banks and encourage them to help connected non-member institutions. The Federal Reserve Bank of St. Louis adopted a narrower position and limited assistance. The different outcomes later became powerful evidence that policy mattered. Areas receiving stronger support experienced less severe disruption than areas where banks were allowed to fail in greater numbers. The comparison does not prove that every bank could or should have been saved. It shows that panic was not simply a force of nature. The doctrine inside the institution also mattered. Some officials believed that economic contraction was exposing weak banks and unproductive investments that should never have existed. Providing extensive support they feared might protect reckless institutions, reward speculation, or create inflation. There was truth inside the concern. Not every bank was merely illiquid. Some had made disastrous loans and possessed assets worth less than their obligations. Yet a panic does not separate the guilty from the innocent with precision. It forces sound and unsound institutions to sell assets into the same collapsing market. By treating widespread failure as a process of necessary liquidation, policymakers risked destroying the machinery required for recovery. A policy intended to preserve financial discipline was weakening the system's ability to distinguish a viable borrower from a hopeless one. Milton Friedman and Anna Schwartz would later emphasize the monetary consequence. When a bank failed, deposits disappeared or became inaccessible. When depositors hoarded currency, fewer funds remained available for banks to lend. When frightened banks accumulated reserves, the same monetary base supported fewer deposits and fewer loans. Between 1929 and 1932, both the American money supply and bank lending declined by more than 30%. This was not an abstract change in a statistical series. Checking deposits were among the principal means by which businesses paid suppliers, merchants financed inventory, and employers met payroll. The economy was losing the instruments used to conduct ordinary exchange. Less money produced falling prices. Falling prices weakened profits. Weaker profits created additional defaults which damaged additional banks. Ben Bernanke later added that bank failures destroyed more than money. A local banker possessed information that could not be replaced by a line in a national database. The banker knew which manufacturer had survived previous downturns, which farmer owned valuable land, which merchant paid slowly but reliably, and which borrower was concealing losses. When the bank disappeared, those relationships disappeared with it. A surviving firm could have valuable machinery experienced workers and real demand for its products, yet still be unable to obtain working capital because no distant lender understood its business. Credit became more expensive for some borrowers and completely unavailable for others. The collapse of financial intermediation turned temporary distress into permanent closure. Once a factory was dismantled and its workforce scattered, restoring the money supply could not instantly rebuild what had been lost. Deflation then transformed old debts into heavier burdens. Irving Fisher described the mechanism as debt deflation. A farmer might owe the same number of dollars after crop prices fell, but each dollar now represented more wheat, more labor, and more land. A business could reduce wages and prices, yet discover that its loan payments remained fixed. To obtain cash, debtors sold assets. Those sales pushed asset prices down further, weakening the balance sheets of other borrowers and banks. The effort to repay debt increased the real weight of debt across the economy. This was the cruel arithmetic of the Depression. Individuals attempted to become safer by saving more, selling assets, and reducing spending, but their combined actions reduced income and made repayment more difficult. The system punished the behavior that appeared most prudent. Then the crisis returned to Europe. In May 1931, Austria's largest commercial bank, Credit Anstalt, disclosed losses so serious that the government and central bank were drawn into an emergency rescue. The institution's failure did not mechanically destroy every European bank, but it changed expectations. Investors began asking which government could support its banks, which banks were hiding losses, and which country might be forced to abandon gold. Withdrawals and currency pressure moved through Austria, Hungary, and Germany. International assistance arrived slowly and was constrained by political disputes, reparations, and the fear of rewarding unreliable debtors. A financial emergency requiring speed became entangled with the unresolved conflicts of the post-war settlement. Europe did not lack people who understood the danger. It lacked an institution powerful enough to act before national interests blocked collective rescue. Pressure eventually reached Britain. On September 21, 1931, after heavy losses of reserves and a collapse of confidence in sterling, Britain left the gold standard. For Britain, departure created room to pursue easier monetary conditions. For the United States, it created fear that the dollar might be next. Foreign governments and private investors converted dollar assets into gold. American depositors, already worried about bank failures, withdrew currency at home. The Federal Reserve now faced two drains at once: gold leaving the country and cash leaving the banks. It responded forcefully to the external danger. The New York Reserve Bank raised its discount rate from 1.5% to 2.5% on October 9th, and then to 3.5% 1 week later. The action helped stop the gold outflow. It also tightened credit during a banking emergency. More than 500 commercial banks closed during October. The public justification was monetary credibility. If the United States failed to defend gold convertibility, officials feared that international confidence in the dollar would collapse. The domestic consequence was deeper deflation. This was not a choice between stability and irresponsibility. It was a choice over which form of stability would receive protection. The gold value of the dollar was defended while deposits, businesses, and employment continued to disappear. Protectionism reinforced the division. The Smoot-Hawley tariff, signed in 1930, did not single-handedly cause the collapse of world trade, which was also driven by falling income deflation, exchange controls, and commodity price declines. But higher barriers and foreign retaliation made it more difficult for debtor countries to earn export revenue. A system demanding international payment was closing the markets through which payment could be obtained. Herbert Hoover's administration did not simply watch without acting. It supported public works, encouraged voluntary cooperation, backed the creation of the Reconstruction Finance Corporation in January 1932, and approved legislation expanding the forms of collateral the Federal Reserve could accept. The new corporation could lend directly to banks, railroads, and other financial institutions, including some without normal access to Federal Reserve credit. Later research suggests that its assistance helped many banks survive. but its early intervention remained constrained by collateral rules, institutional caution, and the stigma attached to borrowing. A bank requesting aid risked advertising its weakness to the public. The Federal Reserve also began large-scale purchases of government securities in the spring of 1932. Money stopped contracting as rapidly interest rates declined, and several indicators improved. Then the purchases ended before a durable recovery had taken hold. By early 1933, the system was entering its final panic. Bank failures intensified in the Midwest and West. States declared banking holidays to stop withdrawals, beginning with Nevada in October 1932. But closing banks in one state encouraged depositors elsewhere to demand cash before their own banks could be closed. The presidential transition added uncertainty. Franklin Roosevelt had defeated Hoover in November, but would not take office until March under the calendar then in use. Gold left the country. Currency disappeared into private hoards. Banks restricted payments, limited withdrawals, or locked their doors. By the time Roosevelt stood before the Capitol on March the 4th, the financial system could no longer guarantee that a deposit was money that a check would clear, or that a solvent business could obtain credit. The crash had become a banking catastrophe. The next question was, what had been sacrificed to defend the old order? Who bore responsibility for that sacrifice, and why recovery began only when the rules themselves were changed? By March 1933, the price of defending the old system could be measured in locked bank doors. Across the United States, families stood outside institutions that held their savings but could no longer promise to return them. Businesses could not be certain that checks would clear. State governments imposed emergency closures while withdrawals in neighboring states accelerated before the same restrictions could arrive. The gold value of the dollar had been defended, but the domestic meaning of money was disintegrating. A bank deposit was supposed to be purchasing power available on demand. Now it had become a claim trapped behind glass and steel. The Depression had reached the point where preserving confidence required more than another loan or another statement from Washington. The government had to suspend ordinary banking in order to save banking itself. Franklin Roosevelt entered office on March the 4th and declared a nationwide bank holiday beginning 2 days later. The action was extraordinary, but the logic was simple. A bank run could continue only while frightened depositors were able to demand cash faster than institutions could obtain it. Closing the bank stopped the immediate race and gave federal authorities time to examine balance sheets, organize support, and decide which institutions could reopen. Congress passed the Emergency Banking Act on March 9th with remarkable speed. The law confirmed the closure, expanded federal authority, and allowed the Reconstruction Finance Corporation to strengthen banks by purchasing preferred stock rather than merely offering loans. The government was no longer waiting for confidence to return. It was using public power to rebuild the conditions under which confidence could become rational. Yet legislation alone could not repair a system based on public belief. On March 12th, Roosevelt addressed the country by radio and explained banking in language ordinary listeners could understand. Banks did not keep every deposited dollar in a vault. They invested and lent much of it. The crisis had come because too many people demanded currency at once. Roosevelt's message did not promise that every institution was safe. It promised that banks allowed to reopen had passed government review and would have access to the currency they required. The next morning, banks began reopening in stages. Instead of withdrawing everything available, many Americans redeposited money they had hidden in homes and safe deposit boxes. The panic receded because the government had changed the expectation at its center. Cash would be available, so fewer people needed to demand it immediately. Stopping the bank run was only the first break with the old order. The deeper shift involved gold. For years, American monetary policy had been restricted by the promise that dollars could be converted into gold at a fixed price. That commitment carried prestige abroad, but during the Depression it encouraged the government to protect reserves even when the domestic economy needed more money, higher prices, and easier credit. Roosevelt restricted gold movements, ended domestic convertibility, and moved the United States away from the old parity. The Gold Reserve Act of 1934 eventually fixed gold at $35 an ounce, reducing the gold value of the dollar and increasing the dollar value of the government's reserves. The purpose was not to create prosperity through accounting. It was to escape a rule that had forced falling prices and mass unemployment, to serve as instruments of currency defense. The result was a change in expectations. For years, businesses and households had delayed purchases because they expected prices to keep falling. A machine would be cheaper next month. A crop would earn less at harvest. A debt would become harder to repay. Once the government signaled that it intended to raise prices rather than defend deflation, holding cash became less attractive, and borrowing became less punishing. Gold inflows and monetary expansion supported an increase in the money supply. Agricultural prices rose from their lowest levels. Industrial production began recovering. None of this restored the economy overnight, and some early New Deal policies created new uncertainties of their own. But the direction of policy had reversed. Before 1933, government action had repeatedly adapted the economy to the monetary system. After 1933, the monetary system was increasingly adapted to the needs of the economy. The banking structure was also rebuilt around a new promise. The Banking Act of 1933 created the Federal Deposit Insurance Corporation, and federal deposit insurance began at the start of 1934. Depositors at participating banks no longer had to investigate a bank's loan portfolio before deciding whether to leave their savings inside. If the institution failed, insured deposits would still be protected. That guarantee changed the mathematics of panic. A person with no insurance had a reason to run at the first rumor. An insured depositor could wait. The same law also separated important areas of commercial and investment banking through provisions commonly associated with Glass-Steagall. These reforms did not eliminate financial risk, but they transferred part of the burden of maintaining confidence from frightened individuals to supervised institutions backed by the federal government. Wall Street faced a parallel reconstruction. The Securities Act of 1933 required companies selling new securities to provide investors with significant financial information. The Securities Exchange Act of 1934 created the Securities and Exchange Commission and established federal oversight of exchanges, brokers, dealers, and publicly traded companies. The underlying principle was not that government could guarantee a profitable investment. It was that markets could not sustain legitimacy when insiders possessed information unavailable to the public, when financial statements were unreliable, or when manipulation could be disguised as genuine demand. The crash had shown that capital markets were not private casinos isolated from the rest of society. When securities financed factories, utilities, banks, and household wealth, the integrity of those markets became a public concern. Financial reform stabilized the machinery, but millions of Americans still needed income. New Deal agencies placed people on roads, bridges, parks, schools, dams, and conservation projects. Relief payments supported households that private charity and local government could no longer sustain. Agricultural programs attempted to raise farm income. Public employment restored a wage to people whom the market had discarded. The economic effects extended beyond the worker holding the shovel. A relief paycheck entered grocery stores' rent, payments, clothing purchases, and local tax receipts. But the human meaning was larger than the multiplier. Work restored routine and public visibility. It allowed a parent to return home carrying wages rather than another account of rejection. It could not replace lost savings or years of interrupted education, but it reduced the humiliation of being treated as economically unnecessary. The New Deal did not distribute protection equally. Agricultural and domestic workers were excluded from important parts of the original Social Security system, leaving many black workers and other vulnerable laborers outside its early coverage. Local administration allowed discrimination to shape relief and employment opportunities. Mexican immigrants and Mexican Americans faced repatriation campaigns during the unemployment crisis. Women were frequently treated as secondary earners even when their wages supported entire households. And recovery remained incomplete. Factories reopened, production increased, and the banking system became more stable, but millions remained unemployed long after the emergency legislation of 1933. The New Deal changed the direction of the economy and the responsibilities of government. It did not instantly repair every community, erase racial hierarchy, or deliver full employment. The international comparison makes the role of monetary constraint difficult to ignore. Countries that abandoned gold gained greater freedom to lower interest rates, expand credit, and stop forcing domestic prices downward to defend fixed exchange rates. Their experiences were not identical, and leaving gold was not a universal cure. Political institutions, banking systems, trade exposure, and fiscal policies still mattered. Yet the broad pattern was revealing. Nations that escaped the gold constraint earlier generally began recovering earlier, while those that defended parity longer tended to endure deflation for longer. The old system had promised stability by binding governments to a common rule. During the Depression, that rule synchronized contraction. Recovery began when national governments accepted that preserving employment and banking systems might require breaking the monetary promises inherited from the previous decade. The recession of 1937 and 1938 exposed how fragile the recovery remained. Believing the emergency was passing, federal policy shifted toward restraint. Government spending growth slowed. New Social Security taxes began drawing purchasing power from paychecks. The Treasury sterilized gold inflows rather than allowing them to expand the monetary base, and the Federal Reserve increased reserve requirements for member banks. Historians continue to debate the relative importance of these measures, and later research has questioned whether reserve requirements alone caused the contraction. But the combined change in policy was followed by a severe reversal in production and employment. Recovery resumed after fiscal policy became more expansionary. Reserve requirements were partly reduced and the Treasury released previously sterilized gold. The lesson was not that every dollar of government spending guaranteed growth. It was that withdrawing support from a still-damaged economy could reactivate the forces of contraction. Responsibility, therefore, begins with the institutions that possessed the power to interrupt the collapse and failed to use it soon enough. The Federal Reserve did not create every weakness of the 1920s. It did not write the Treaty of Versailles, design every state banking law, force farmers to borrow, or compel investors to purchase stocks on margin. But once banking panics began, the central bank allowed money and credit to contract on a catastrophic scale. It protected gold convertibility more decisively than it protected the domestic payment system. Its regional structure produced inconsistent responses, while its doctrines encouraged officials to distinguish deserving from undeserving banks during a panic that was destroying both. One institution did not cause the entire depression. Its failures nevertheless transformed a serious downturn into something far more destructive. The strongest counter-argument is that monetary policy cannot explain everything that had already gone wrong. Peter Temin emphasized the collapse of demand. Christina Romer argued that the crash increased uncertainty and discouraged purchases of durable goods. Irving Fisher showed how deflation enlarged the real burden of debt. Milton Friedman and Anna Schwartz placed monetary contraction and Federal Reserve failure near the center of the disaster. Ben Bernanke demonstrated how bank failures destroyed lending relationships and information, not merely deposits. Barry Eichengreen revealed how the gold standard transmitted pressure internationally, while Charles Kindleberger emphasized the absence of a power willing and able to stabilize the world economy. The debate produces no single villain because the catastrophe was a chain. The crash weakened spending. Bank failures destroyed money and credit. Deflation intensified debt. Gold restricted policy. Political division delayed rescue. The price was not paid only in output tables. It was paid in homes abandoned after foreclosure, in children leaving school to search for work, in families separated by migration, and in illnesses left untreated because cash had disappeared. It was paid by unemployed workers competing across racial and ethnic lines that politicians and employers could exploit. Internationally, the collapse encouraged protectionism, currency blocks, economic nationalism, and the search for self-sufficiency through territorial power. The Depression did not make dictatorship or world war inevitable. Political choices still mattered, and responsibility for aggression remained with those who chose it. But mass unemployment and institutional failure weakened democratic legitimacy, strengthened extremist movements, and made international cooperation harder at the precise moment when cooperation was most necessary. Return now to the crowd outside the New York Stock Exchange in October 1929. The panic in that image was real. The fortunes lost were real. The crash damaged confidence, reduced spending, and exposed the leverage hidden beneath the prosperity of the 1920s. Popular history is right to remember it. What popular history often misses is the sequence that followed. A market collapse became a depression because banks failed, deposits vanished, credit relationships were destroyed, prices fell. Debts grew heavier, international payments broke down, and governments defended monetary rules that narrowed their ability to respond. The crash revealed the weakness of the system. Institutions made the weakness catastrophic. The Great Depression was not caused by one day, one law, one president, or one group of financiers. It emerged from a post-war order that depended on continuous lending, fixed exchange rates, fragile banks, and political cooperation that disappeared under pressure. The deepest failure was not that officials could not predict every consequence. It was that they continued protecting the architecture of stability after that architecture had begun exporting panic. Recovery started when the United States guaranteed banks expanded public responsibility, loosened the gold constraint, and accepted that markets required institutions capable of stopping collective fear from becoming collective ruin. If this documentary changed how you understand the Great Depression, subscribe to the Price of History docs and like the video. And tell us in the comments which mattered most, the Federal Reserve, the banking panics, debt deflation, or the gold standard.